Hello viewers, welcome to my channel. So now I'm going to explain you the remaining part, theory part of cash flow statement. In the last video, I have explained you in detail regarding the meaning of the term cash flow statement, its importance, differences between funds flow statement, cash flow statement, and how to make, what are the provisions regarding the preparation of cash flow statement according to AS3. Accounting Standard 3 issued by ICAI. So before start making the cash flow statement, first of all you must be clear regarding the terms used. So I have explained you in detail regarding the cash, cash equivalent, cash flow, operating activity, investing activity, financing activity, all these things I have explained in the previous video. So if you have not watched that video, I suggest you to go to the playlist of my channel, select the subject financial statement analysis. In that subject, select the video cash flow analysis. In that video, first video, if you watch, definitely you can be able to understand the meaning of the term cash flow statement. Now, continuing that part, in this video, I am going to explain you about the format of cash flow statement, how the cash flow statement is prepared. So these two videos are very, very important. Without understanding these two videos, you cannot be able to solve the problem easily. So if you want the complete command on the subject, on the topic, watch these two videos with full concentration till the end. Now, see here, format of cash flow statement. There is no specific format given by ICAI in AS3 that this format should be followed. No, it is only expecting that cash flow statement should depict clearly the net cash flows. The net cash flows from the three activities, that is cash flow, net cash flow from operating activity, net cash flow from investing activity, net cash flow from financing activity. After calculating these three net cash flows, we will add up and find out whether there is total net increase or decrease in the total cash flows. To that you add the opening cash and cash equivalent. You add the opening cash and cash equivalent. The resulting figure will be the closing cash and cash equivalent. That's all. So the only expectation is calculate the net cash flow for the three activities and then sum up. That's it. Now, how to make the cash flow statement, the format, example I have given here. By seeing, by watching, by listening this lecture, you will be in a position to understand the complete format, how we have to make the cash flow statement. Now, first of all, the name of the company will write down cash flow statement for the year ended. For which period we are making the cash flow statement. Particulars, amount, two inner column, one outer column. So two columns we are making. First of all, we are going to write cash flow from operating activity. The first activity we are taking, operating activity. In this, we will begin our calculations with the net profit as shown by the financial statements. In the financial statements, the current year's profit will be given, or 2 years profits will be given. Last year and current year we compare and find out whether there is increase or decrease in profit. Whatever is the case, we take the net profit as per the financial statements. This profit will be before tax and before any extraordinary items. This profit should be only from ordinary activities. So after taking the net profit, we adjust for non-cash, non-operating items. In financial statements, while calculating net profit, we take all items, whether it is cash or non-cash, whether it is operating or non-operating. See, in the normal traditional profit and loss statement, we take all expenses, whether it is cash expense or non-cash expense. Example, depreciation, loss on sale of asset, or this type, amortization expenses. These are the items which does not involve any cash. It is non-cash expense, and these non-cash expense already taken into account in calculating this net profit. After adjusting all non-cash items, we got the net profit. Now we have to adjust, reverse back. Example, depreciation was already taken in calculating the net profit. That depreciation we add back here. Similarly, goodwill written off or patent written off or any intangible written off that already we have taken in calculating the profit, that is a non-cash item, we add back here. Similarly, loss on sale of asset, it's a non-cash. So again, it was considered while calculating the profit. Now we add back. So all the non-cash, non-operating items should be adjusted here, right? Should be adjusted. Add non-cash expenses and non-operating expense and deduct non-cash incomes. Similarly, non-operating incomes. Example, in the profit and loss statement, suppose interest received, dividend received. So this interest received and dividend received are not operating incomes. It is non-operating income. So here we have to deduct it because already it is included in net profit. Now we have to deduct. So remember the rule. Adjustment for non-cash, non-operating items. It may be an item of expense or it may be an item of income adjustment. Then what we get is operating profit before working capital changes. This is called. That means we took the net profit. To this we have adjusted all non-cash, non-operating items. After making all adjustment, we got operating profit before working capital changes. To this we have to make the adjustment for working capital changes. Working capital consists of current assets and current liabilities. Now we have to compare the current assets and current liability of last year with the current year, because two balance sheets will be given in the problem. So last year current asset will be compared with the current asset year, current asset of current year. Then some current assets may increase, some current assets may decrease. Some current liability may increase, some current liability may decrease. So by comparing this increase and decrease, we have to make the adjustment. So how to make the adjustment while doing the problem, I'll explain you. Right now you remember one rule. Increase in current liability, decrease in current asset should be added. Here you have to add up adjustment for working capital changes. In this one, remember the rule. What is that rule? Increase in current liability, decrease in current asset should be added and the reverse will be deducted. Increase in current liability is added, so decrease in current liability is deducted. Similarly, decrease in current asset is added, so increase in current asset should be deducted. So no need to remember both the rules. Only one rule you remember, automatically the contrary will be done the opposite. Example, increase in current liability, decrease in current asset should be added. That much you have to remember. So after making adjustment for working capital changes, the resulting figure is called cash generated from operations before tax. Cash generated from operations before tax. From this we deduct the tax. So ultimately we got net cash flow from operating activity. This is the net cash flow from operating activity. It may be positive, it may be negative. If it is positive, keep it as it is. If it is negative, put it in bracket. Put it in bracket. So you may get positive or negative. Positive means without bracket, negative means with bracket will write. Next, cash flow from investing activity. Investing activity are the activities related to acquisition and disposal of fixed assets and long-term investments. Acquisition means purchase and disposal means sale. The purchase and sale of fixed asset and non-current investment or long-term investment, that will be taken in investing activity. So example are sale of fixed asset. Sale of fixed asset is an income, is an inflow. Sale of fixed asset is an inflow, so without bracket. Sale of non-current investment, it's an inflow. When we sell the investment, there is cash inflow. When we sell the fixed asset, there is cash inflow. Inflow will be written without bracket. Similarly, purchase of fixed asset, there is cash outflow. So I have to write down in bracket. Bracket denote cash outflow. Cash outflow. So similarly, purchase of non-current investment, there is cash outflow. So I am putting in bracket. Similarly, interest or dividend received on investment, it is inflow without bracket. That's all. So after adding up all, That means wherever there is bracket, you have to deduct, subtract. Bracket denotes subtraction. So addition, subtraction, after making all these things, you will get net cash flow. Net cash flow from operating activities. This may be positive or negative. If positive, no bracket. If negative, put it in bracket. That's all. So two activities completed. First operating activity, second investing activity. And the last activity is financing activity. So cash flow from financing activity. Remember, financing activity shows the size and composition of owner's capital and borrowings. Owner's capital and borrowings. Owner's capital is the share capital. Share capital. That means the changes in the share capital and the changes in the borrowings, debt, debentures will be taken here. So examples, what are the examples that may come under financing activity? Issue of share capital including share premium received. When shares are issued, there is inflow of cash. There is inflow of cash. Similarly, issue of debentures, bonds and other long-term debt instruments. When debentures are issued or bonds are issued or any other long-term debt instruments are issued, it is inflow. Cash is coming in, so without bracket. Short-term borrowings, if short-term borrowings are taken, that is also without bracket. Repayment of long-term loan. Repayment means cash outflow. Repayment of loan. For example, there was a long-term loan and during the current year there is repayment of long-term loan, cash outflow, so put it in bracket. Similarly, repayment of short-term borrowings, redemption of debentures, redemption of preferential capital, interest paid on debt, dividend paid on share capital. These are the examples of items which may be taken under financing activity. Remember, whenever it is paid, put it in bracket. When cash outflow is there, put it in bracket. When there is cash inflow, without bracket. Without bracket means addition and bracket means subtraction, minus. Right? So after adding and deducting all these items, the ultimate figure will be called net cash flow from financing activity. Net cash flow from financing activity. So this net cash flow may be positive or it may be negative. If you are getting negative here, put it in bracket. Put it in bracket. So all the three activities completed. First of all, we calculated the net cash flow from operating activities here, outer column. Second column. We are not concerned with the first column. Now second column, this is the net cash flow from operating activity. And this is the net cash flow from investing activity. And the net cash flow from financing activity. So three amounts are there in the second column. These three amounts may be positive, may be negative. May be negative. If positive is there, take plus sign. If bracket is there, take it minus sign. Then ultimately after summing up these three items, you may get net increase or decrease in cash and cash equivalent. If you are getting positive, write down net increase in cash and cash equivalent. If you are getting negative here, write down net decrease in cash and cash equivalent. That's all. To this we add opening cash and cash equivalent or cash and cash equivalent at the beginning of the year. At the beginning of the year, that you add up to this net increase or decrease. After adding up, you will get cash and cash equivalent at the end of the year. Cash and cash equivalent at the end of the year. Now you tally this amount with the balance sheet, with the balance sheets given for the last year and current year. So current year balance sheet, if cash and cash equivalent, if you find, you should get the same value what you are getting here. So if you do the problem correctly, then it will tally. That means whatever cash and cash equivalent you are going to get here, the same cash and cash equivalent will be there in the problem. Current year balance sheet, end of the year, you will have the same cash and cash equivalent. That's all. So this is the format of making cash flow statement. So if you watch this with full concentration, definitely easily you can do the problems on cash flow statement. So we have seen what is the format of preparing the cash flow statement. So just now I have shown you the format of making. Actually, AS3 has not prescribed a particular format. It simply says the cash flows should be divided into three categories: cash flow from operating activities, cash flow from investing, and cash flow from financing. The net cash flows it is asking you to calculate under the three broad heads. Now we will discuss the detail about these three heads. The students should be clear in mind regarding how to find out the net cash flows from operating, investing, and financing activities. Now I am going to explain you about in detail each one. First of all, I will explain you about cash flow from operating activity. See, listen carefully here. Usually, a business organization will prepare the financial statements, will prepare the income statement following the accrual basis. So, according to accrual basis, all expenditure of the current year, whether paid or not, similarly, all revenue of the current year, whether received or not, will be considered. Similarly, the non-cash items like depreciation, goodwill written off, like this, all these non-cash, non-operating expenses, all these things will be considered while calculating the income statement. So whatever profit we got in that income statement will not be equal to cash generated from operations. The cash from operations is not equal to the profit. That means simply we can say the profit which we got in income statement is not equal to cash generated from operations. That cash generated from operation will be different. So how to find out that cash generated from operations? That means AS3 has suggested two methods. How to find out this cash from operating activities or cash from operations? There are two methods specified by AS3. The first method is called direct method. In this direct method, we take into account what are the sources from which there is cash inflow and what are the applications where there is cash outflow. We calculate separately the total of cash inflows and total of cash outflows in operating activity. In this operating activity, how much is the cash inflow, how much cash outflow, separately we calculate. Subtract cash inflows minus cash outflows, we'll get the net cash flows from this operating activity. The method is very simple, straightforward, but practically it will be difficult because separately we have to calculate all the cash flow from operations apart from that income statement. Apart from the balance sheet and income statement, we have to calculate separately all the cash inflows from operations and cash outflow from operations. It will be difficult. Directly it is not available. So cash sales, cash inflows normally will be there from sales. So sales again are of two types, cash sales and credit sales. We can easily get how much are the cash received on sales from cash sales. But credit sales, how much amount is collected from debtors, from customers. So we have to open the account, debtors account, to find out how much amount collected from debtors on account of sales. Similarly, purchases. The main payment is for purchases. Again, two types of purchase are there, cash purchase, credit purchase. For cash purchase, easily we can find out how much is the payment made for cash purchase. But for credit purchases, how much amount we have paid to creditors. We have to open the account of creditors in order to find out how much cash paid to creditors. So all these are the complications that will arise while following the first method called direct method. So normally direct method will not be adopted to find out cash flow from operating activity. Indirect method will be followed. Here I have given, in this method, cash receipt and cash payments pertaining to operating activities are separately and individually stated. Separately we have to find out how much is the cash inflows and cash outflows from operating activities, and the difference between these two is called cash flow from operating activities. This method appears to be very simple, but it is required information is not readily available. Whatever information we require, how much cash inflows, how much cash outflows are not readily available. Separately we have to calculate. We have to prepare debtors account, creditors account, etc. to find out cash received and cash paid while calculating cash from operating activity. Using direct method, non-cash expense such as depreciation written off on fictitious assets should be, preliminary expenses, goodwill should be ignored. So if we follow this direct method, Non-cash items like depreciation, then goodwill written off, preliminary expense written off, these are non-cash items. This should not be considered while following direct method. In simple, we can say the direct method is a complicated method because we have to collect the data separately. The data is not readily available. We have to open the accounts. One more thing. According to Schedule 3, the terminology of various terms have changed. Earlier, we call it as sales. Now it is, according to the new format, schedule, it is asking you to say revenue from operations. So instead of sales, we call it as revenue from operations. Instead of cost of goods sold, we call it as cost of revenue from operations. Similarly, debtors will be called as receivables. Creditors will be called as payables. Stock will be called as inventory. So this terminology has been changed. From the problems which we are going to do, we will come across even the old terms like debtors. We will use interchangeably. That means sometimes we call it as debtors, sometimes we call it as receivable. Both are one and the same. Similarly, sometimes we call it as creditors, sometimes we call it as payable. But according to new terminology, we should use new only. That means receivables, payables, inventory, revenue from operation, cost of revenue from operation. These are the terms we have to use. So this is the direct method. The second method is indirect method. And this indirect method will be widely used. And even in the problem which we are going to do, we will follow indirect method. It is comparatively little bit difficult method, but the data will be readily available. No need of separately finding out the data. Whereas in the case of direct method, separately we have to collect the data. Here already data is there. Simply make some adjustment and easily we can find out cash flow from operating activities. So what is this indirect method? The indirect method is also known as shortcut method. Involves calculation of cash from operating activities by making adjustment to the net profit or loss stated in the income statement. Already income statement is prepared. This income statement is also a new term which is used. Earlier it is called profit and loss account. Now the name of profit and loss account is changed. Now it is saying income statement. So we will take the profit or loss as per the income statement. To this profit or loss as per income statement, we'll make some adjustment. So after making adjustment, we can easily get what is the net cash flow from operating activities. So what is the adjustment? Surplus as per balance sheet at the end of the year. Surplus means profit. Surplus means profit. Deficiency means loss. So surplus as per balance sheet at the end of the year minus surplus as per the balance sheet at the beginning of the year. So we have two balance sheets, beginning of the year, end of the year. So we compare what is the surplus at the end of the year and what is the surplus at the beginning of the year. So first we take surplus at the end of the year. From that we deduct surplus at the beginning of the year. What we get is surplus earned during the year. This surplus earned during the year may be positive or negative. If it is negative, it means deficiency. Positive, surplus. So we take first the difference, then we'll add back. We will make the adjustment for non-cash, non-operating items. Non-cash, non-operating items. So a number of non-cash, non-operating items already adjusted in calculating this surplus. In the income statement, while making the income statement, while calculating this surplus, already all the adjustment regarding non-cash, non-operating have been done. Now we have to reverse it because we don't require profit. We want cash from operations. We want cash profit. We don't want total profit. Only cash profit we want. That is called cash from operating activity. So add back. Whatever non-cash items already debited to profit and loss account, now we add back. Example of those items are transfer to various reserves. In the problem it will be given that during the current year some amount has been transferred from this profit and loss statement to reserve, general reserve. Now whatever amount has been transferred, that will be added back. That will be added back. Similarly, provision for tax during the year. During the current year, some provision for tax has been made. Tax paid is different and provision for tax made is different. So provision made is a non-cash item. Provision for tax made during the year is a non-cash item. Add back. Similarly, proposed dividend. Dividend paid is a cash transaction, whereas proposed dividend is an expected dividend. It's only an adjustment, non-cash. So proposed dividend and back. Interim dividend paid during the year. Interim dividend, if it is paid, it will be taken in financing activities. Dividend paid will be taken in financing activities. It will not be taken in the profit and loss statement. Income statement, it should not be taken. If it is taken, add back. Then fictitious assets written off, like goodwill written off, patent right written off, or discount on the issue of shares, preliminary expenses written off. So any fictitious or intangible assets written off, that will also be added. So these are the examples of those non-cash items which are debited to profit and loss account but does not involve any cash. These will be added back. Then less non-cash, non-operating incomes. If while calculating the surplus, if there are any non-cash or non-operating incomes are there, that incomes will be deducted. Expenses and losses are added. Incomes and gains should be deducted. Example, profit. Example are not, I have not given here. Examples are profit on sale of investment, profit on sale of asset. These are the non-cash incomes. This will be deducted. What we get is profit before tax and extraordinary items. So this is the indirect method of calculating cash from operating activities. Cash from operating activity. So after calculating this profit before tax and extraordinary items, now you remember some terms. The terms are non-cash expense. Non-cash expense are those transactions, those expenses in which cash is not involved, but those transactions are debited to profit and loss account. While calculating the profit, we have already charged those expenses which does not involve any cash. Examples of those expenses are depreciation. Classic example of non-cash expense is depreciation. It is only provided in the books of accounts. No amount is involved. Similarly, bad debts. Bad debt is a loss. It is only a transaction which does not involve any cash. So bad debts. Provision for bad debts, discount allowed, provision for discount, goodwill written off, preliminary expense written off, etc. Remember, these items are called non-cash items. And these non-cash expenses will be added back to profit while calculating cash from operations. Similarly, non-cash incomes. Non-cash incomes should be deducted. So what are the examples of non-cash incomes? Provision for discount on creditors, reserves or provision written back, etc. Examples of non-cash incomes. Next comes non-operating expenses. The non-operating expenses are interest paid on loan, loss on sale of fixed asset, loss on sale of investment, etc. These items are called non-operating expenses. Now, non-operating incomes, profit on sale of fixed asset, profit on sale of investment, interest earned, dividend earned, etc. So remember, non-cash expenses and non-operating expenses. Non-cash expenses and non-operating expenses should be added back. Whereas non-cash incomes and non-operating incomes should be deducted. So after making all this addition and deduction, the resulting figure is called operating profit before working capital changes. Operating profit before working capital changes. Now we have to make the adjustment for working capital. Working capital consists of current assets and current liabilities. So compare the two balance sheets, last year balance sheet and current year balance sheet. When you compare line by line, current assets and current liability, so some current assets may increase, some current assets may decrease. Some current liability may increase, some current liability may decrease. So when you compare the two balance sheets, increase and decrease of current assets and current liability, now we consider. Now we apply the rule. What is the rule here? Rule for changes in working capital. Rule number 1. Increase in current liability, decrease in current asset will be added. Remember the rule. If you remember the rule, then definitely you can do the problem. Otherwise, every problem will be difficult for you. So what is that rule? Increase in current liability, decrease in current asset should be added. So compare the current liability. If the current liability is increasing, add. If the current asset is decreasing, add. So add items you remember. automatically you can remember the less items, deducted items. Opposite, when we are adding increase in current liability, you are adding, that means decrease in current liability, you have to deduct. Decrease in current liability deducted. Similarly, decrease in current asset you are adding. Decrease in current asset you are adding. So increase in current asset you subtract. So only remember one rule, automatically second rule you can be able to remember. First rule, increase in current liability and decrease in current asset should be added, that's it. So apply this rule. After applying these rules to all current assets and current liability, we will get net cash flow from operating activities. You will get a broad eye view, bird's eye view regarding how to calculate this cash flow from operating activity. The second activity is cash flow from investing activity. Investing activities are those activities which are concerned with acquisition and disposal of fixed assets and non-current investments, long-term investments. So cash flows pertaining to purchase and sale, acquisition and disposal means purchase and sale of fixed assets and non-current investment will be presented under this head. So any income received from investment, if any income is received from investment like interest received or dividend received on investment will be considered as investing activity, cash flow from investing activity. So any income received from investment will be shown under investing activity. Thus interest on investment in equity dividend or preference dividend received will be considered as cash flow from investing activity. So 4 items you have to remember. What are the 4 items? Purchase and sale of fixed assets or purchase or sale of long-term investment, non-current investment. Any income earned or any income earned on the investment in the form of interest or in the form of dividend received will be taken under investing activity. Last and final, cash flow from financing activity. Cash flow from financing, all transactions that relate to funding or financing of the business comes under this head. Funding or financing, from where the business has procured the funds. The business will procure the funds either from the owners or from the borrowings. The business will procure the funds either from the owner's capital or from the borrowings. So both will come under financing activity. Example, when equity shares are issued, when preference shares are issued, when debentures are issued, when bonds are issued, all these things will come under financing activity. So here issue of shares, equity and preference, debentures, bonds, long-term or short-term loans taken are all cash inflows. Cash money is coming in by issuing shares, by issuing debenture, by issuing preference share, or by taking a bank loan, long-term loan or short-term loan. Similarly, redemption of preference shares. Redemption means returning back the money on preference shares. That is called redemption of preference shares. And redemption of debentures, repayment of short-term or long-term loans are cash outflows from financing activities, are all cash outflows. So you have to see whether there is inflow of cash or outflow of cash regarding all these activities. That will be taken under cash flow from financing activity. Lastly, all interest and dividend paid are cash outflow from financing activity. Interest paid or dividend paid on this will be taken under cash flow from financing activities. So in this video, I have explained you the format of cash flow statement and explained you in detail regarding the cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. Now you are in a position to solve the problems on cash flow statements. So these 2 videos are very, very important. Without watching the complete these 2 videos, you should not go to the problem. Otherwise, you may not be able to understand. So hope you are satisfied with my lecture. If you are satisfied, give a like to the video. Give your comments on these lectures. Share my channel in your group, in your friend circle, so that more students can watch the video and enhance the knowledge. And subscribe my channel if you have not yet subscribed. Inshallah, we will start the problems on cash flow statement in the next video.